Hello friends, welcome back to our channel Trade with Books. Today we learn that how you can assess a true value of a stock. The value is very complex thing. We cannot judge that whatever price we are paying for a stock is correct or not. So today we'll try to find out that how you can assess a company with some numbers like return on equity, what should be the P ratio, what are the uses of PEG ratio. This all we'll use, what is the ideal number for this, and how you can judge that whatever stock you are going to purchase in certain price, whether that price is correct or not, whether you have sufficient margin of safety or not. So if you have not subscribed to our channel, you can subscribe if you like our video. So let's start. This presentation was given by Mr. Ramdev Agrawal, which is who himself is a known investor, and this was a event by Motilal Oswal. So all credit goes to these two, Motilal Oswal and Ramdev Agrawal. I have simply copied their presentation material and I'm going to explain you in detail so that my community, my followers, my subscribers also can learn this and they can also utilize this. This is my whole objective. So the essence of equity investing, in when you are going to invest in equity, you have to identify what is the gap between the value and price which you are paying, and what is the value, the true value of the stock. Suppose you are paying 1900 for HDFC Bank, and you should know that the current value of this stock is around 1200 to 1300, so you are paying some 700 additional in terms of one share. In terms of total market cap also you can assess. So when you know that you have sufficient, you have a large gap, you know that stock can correct a lot of amount, so you don't have sufficient margin of safety. But suppose you are purchasing a stock near to its value. Near to its value means you can be sure that if that stock start correcting also, you have sufficient margin of safety. So that is the whole concept of value price gap. So first point is you have to assess the value. What is the current value? Then you have to compare with the price, and you have to buy only if there is sufficient margin of safety. Okay, this is our whole objective from this PPT. So we'll try to know that what is the value. So price is what you are paying and value is what you are getting in return of that. This is our value and price difference. So what is value? Value is the present value of lifetime cash flow. The stock is having a business behind it, so the business is generating cash. So somehow if you get to know how much cash it is going to generate in future in its lifetime, you can get the sense of what is the true value. That is very difficult task for a retail player. That is very difficult to assess the future earning and future cash flow of a stock. So we'll try to make it in simple terms like you and me can use. What should be the ROE number, what should be the growth number, what should be the PEG number, P divided by growth, what are the other parameter which simply we can go to screener.in or such sites, and we can have some margin of safety in our purchases, so that we will be sure that we are purchasing at the true value or right value. We cannot be very sure, but at least we will improve our performance. That is my whole objective. So first slide or first valuable insight what I got from this slide and what Ramdev Agrawal tried to show is that ROE, earning growth, and cost of equity, this all three determines the value. One by one we'll go through very slowly. You will understand at the end of this presentation that what should be the numbers and how you can improve your performance when you are investing or trading. So ROE, first thing is ROE, return on equity, then earning growth and cost of equity. I am going to explain what is cost of equity in next slide. So this all three things will determine what is the value. So we have to see these numbers. What should be the number? In coming slides it will come. So that all three numbers will determine the value. That value can be called as P ratio, but P ratio is not the true sense or presentation of value. But in simple terms, we see the P ratio of a stock to check the value. So we have to see return on equity, earning growth, and cost of equity. Now question is, what should be the number? So first of all, we have to understand what is cost of equity. See, the Sensex is trading from roughly around 1986. 1980 it has started, but 1980 to 86 it 7 time it gain. So that 7 years we are avoiding. From 1986, if you see, the CAGR the has been 13%. So Sensex has given return of 13% per year around. So that is your cost of equity. One way is this one. The second way is to calculate cost of equity is what is your risk free rate. Risk free rate is around 8%. Suppose FD rate is 8%, that is risk free, no risk is there, so that 8% will take, and plus 5% we will add as a premium for risk we are taking in equity. So you should get at least 13%. How much you should get? At least 13%. So your ROE number, return on equity, should be more than 13% at least. At least. What should be the number? There are many more things, but at least it should be 13%, more than 13%. Now Ramdev Agarwal did one exercise. What he did is, he has seen if the earning growth rate is 20%. Suppose earning growth rate of any company is 20% and ROE is 25%. ROE is 25% and cost of equity is 13%. So it is visible that free cash flow is consistently increasing, you can see. So these are the good numbers. 20% earning growth and ROE is 25%, then free cash flow will continuously increase. And earlier we have seen the value determines with free cash flow of future. So you can say when ROE of 25% and earning growth of 20% you get in any company, you should think about purchasing, because that will give the company free cash flow. Okay, so 25% ROE and 20% growth is the magic number. Now if I change these numbers, you will see the drastic change in free cash flow. Now next slide, if you see, ROE number I decreased. ROE number I decreased from 25 to 14%. 25 to 14 only now. ROE is how much? 14 only. Earning growth I increased to 20 to 30%. But even though earning growths are increased, with decrease in ROE, you can see that free cash flow up to 10 year is negative. So you will not get any free cash flow until around 10 years. After that only free cash flow will start coming. So if you are buying any company now for a long term with around 13-14% or lesser ROE, you can think about you are purchasing that or you are giving that price for after 10 years value addition will happen after 9-10 years only. So you should not buy any company with lesser than 15% ROE. This is what this slide I am going to explain, or I want to explain. I hope my message is clear and you understand that ROE is very important. Even though high earning growth is there, but if ROE number is less, you are not going to get any value addition. So always focus on ROE number. Now this was the first learning we got from this slide. Now the second learning. Second learning is that ROE and growth, these both determine free cash flow. So if ROE is more, suppose 25% ROE you take, so for generating the same PAT, profit after tax, you need lesser capital investment, lesser investment is required. But if ROE is less, 15%, you need more investment. So your free cash flow will be minus. Suppose you are with 133 investment, you are getting 100 PAT. So next time when you need 133 for investment, you have to bring 33 from outside. You don't have 33, you have only 100 rupees profit. So this 33 is negative. But suppose for generating 100 of PAT, you need only 80 investment. Then for next time 80 investment, you have already 100. You have already 100 benefit. So from that 80 you will invest and 20 will be saved with you. That is called free cash flow. So you are generating a free cash flow because of higher ROE. Understand? So higher ROE is very very important. You should always look for higher ROE. Now, the third point. The third point is what? This is the third learning. We have learned two learnings. All growth is not good. Suppose somebody will tell that higher the growth rate is good, but only higher the growth rate is not sufficient. You can see with ROE of 10%. ROE of 10% means lesser than 13%. If growth increases, actually value decreases. The company's value will decrease, means your stock prices may collapse. So ROE is very important with the growth rate. So if ROE is less than cost of equity means 13%, high growth will destroy the value. It will not generate the value, it will destroy the value. If ROE is equal to cost of equity means 13%, this column you can see 13%, then also you can see no value addition is there even with the growth, even with higher growth also no value addition, my friend. So if 13% ROE also is there, there is no value addition with even higher earning growth. So the company should focus on increasing ROE, not on the growth. So you should also not be very excited by seeing higher growth numbers. You should see that whether ROE is increasing or not. Then growth adds value only if ROE is more than cost of equity. This slide is very important. So if ROE is increasing 15, 20, 25%, then only with growth our value addition is increasing. This is what this slide is telling. Okay. Now next point is, beyond a point, increase in ROE does not add much value. Suppose somebody will tell that 60, 70, 80% ROE is better than 20, 25%. No. After a certain point, you can see this growth, this growth will become flat around this point. So even with around 30, 40, this is sufficient. Around 30, 40% if ROE is there around this range, that is more than sufficient for any company. This region you have to see 20 to 40% ROE. This is sufficient, not more than that. After that, increase in ROE also will not help the company to gain value. Next slide. Next, fifth learning. Earning growth and valuation are exponentially correlated. Suppose you are taking a company with 25% ROE. 25% ROE, I have seen that company is maintaining. Then if growth will increase 30, 40%, then the value addition will be exponential. It will increase like anything. So first criteria is ROE 25%, 30%, 20%, then earning growth should come. That is our main aim and we should look for such companies. Next highlight. Suppose a company A is there who is having 30% ROE. A company A is having 30% ROE and growth rate is only 10%. And whereas one company is there where ROE is less but growth rate is more, 20%. Okay, so what should be the focus of these companies? So company A, if he will increase 1% ROE, that will increase in its value only 1, because already high ROE is there. We have seen in last slide that ROE after a certain limit 30-40%, if you increase it will not add to the value. So such high already high ROE company should focus on growth, because if they will increase 1% growth from 20 to 21%, their value will increase 7%. If value will increase, your stock price will also increase. So you should look for companies quarterly performance or annual performance, these things. If company is already having high ROE, you should see that whether growth is increasing or not. If company is having low ROE if company is having, you should see that whether ROE is increasing. If ROE is increasing by 1%, it will add to 12% growth. This is what I am going to tell you. Very calmly, very slowly I am going, so that this will help you full lifetime. This was very good presentation. That's why I decided to take. You can see in this YouTube channel Vice OWL Wealth. In this full video is there, but I thought this is not reached to the level or community the it should be. So I decided to make a video, so you can understand you can what you have to see in quarterly and annual performance of a company. If you have the stock or you are going to buy the stock, if the ROE is lesser for the company, you should see whether ROE is increasing, because 1% increase in ROE will gain the value growth of 12%. If value is increasing, your stock price will also increase. Okay, this was the exercise. If growth is increasing, that will not much gain. If 1% growth will increase for such companies which is already having high growth, it will add only 3% in the value. Then seventh highlight is or learning is that sustaining ROE above cost of equity is a challenge. Cost of equity is suppose 13%. So there are many very less companies who can sustain for a longer period this higher ROE. So you should always be careful that whether your company, whatever you have purchased or going to purchase, or that company is able to hold that ROE for a longer period. It was seen that in 1998, 136 such companies were there, but you can see in 2018 and all, it was only 21, 22 companies who could maintain that high ROE. So your company should be in capable hands, or it should be sufficiently managing by such people that who can maintain high ROE for more than 5-10 years. So that company will generate the wealth. Okay, next learning. Next learning is that hyper earning growth is rarely sustained beyond 5-6 years. If you see some company where growth rate is coming 60, 70, 80%, like currently from 2020 I am seeing one company which is running our Westlife and Judio showroom. Whoever is married, he may be knowing, because uh, wife will be taking them almost a month, every month, to that mall, that showroom Westlife and Zudio. So there you can see new showrooms are coming. um, Peoples are crazy in that, like so much rush to buy clothes. So their earning growth, if you see, that is way beyond 60-70%. But that maintaining that earning growth is very difficult for more than 5-6 years. In it has been seen in India that very less companies are there who are able to sustain it beyond 10 years and all. Like this is HDFC Bank only example, who was able to maintain that, but very lesser companies are there who can maintain that. So you have to be very watchful that whether you are buying this company at the peak of their earning growth. Suppose you are buying a company who is already giving earning growth of more than 50% from last 5 years, you can say that this is the time that it is going to be end. So you are buying at the cliff, at the top of the cliff. But if you are buying a company which is just started to giving earning growth high 1 or 2 year, you can expect it to grow 3-4 years at least. Maybe it is a very good company, once in 1,000 companies which can be giving around 10 years that growth, but it is very rare that more than 5-6 years it will give. So you should be very careful if you are buying a company who is already giving a high earning growth from last 5-6 years. This was the whole objective or learning from this slide. Okay, now seventh insight is that oh, this already we covered. This ninth insight is that what you should see: high ROE, high growth. This was the whole thing until here. There are many more things. Until here, what we learned is you should always look for high ROE and high growth. This formula always works, because high ROE, high growth, you can see from this period 98 to 2008, this 10-year period, it has given almost 27% CAGR, means return, annual return. And in every 10-year period, you can see it has given very good return. You can see. So this formula always works. What you have to see: high ROE company around 25-30% ROE, or 20 to 30 ROE. 20 to 30 ROE you should look for, and growth rate should be What? More than 20%. This formula always works. But this growth rate should be coming just 1 or 2 year, because you should have some time that company will grow in 3 4 more years in this fashion. So this is the learning up to here. High growth, high ROE company. So this is also a matrix shown the same thing. If growth rate, here side it is shown growth and bottom it is shown quality, means ROE. So if high ROE and high growth is there, 27% it has given annual return, whereas Sensex returns were around 14%. But if ROE is less and growth is also less, this has given only 6%, lesser than FD returns. If ROE is lesser and growth is more, that has given around 21% return. And if ROE is high and growth is lower, then it has given 14%, similar to Sensex return. So this is the quadrant you should look for. This is high return, high growth and high ROE. Next what we can learn, that suppose you have find out some company which is having ROE and growth very whatever you demanded, high ROE, high growth. Now how I will judge that what is the, suppose I am paying some price, that price is correct or not. So for that some 5 6 parameters are there, you can look for any one of them. If you get something, you have a multi bagger, chances are there. So first thing is P ratio. P ratio, how much should be, you should see. So single digit P ratio works, and above 50 it doesn't. So suppose you are buying a company or share now that is having more than 50 PE, that is almost not going to work for you. You are going to lose that, like in most of the cases. So you should avoid such high PE ratio companies. And if PE ratio is lesser than 10, you can think about that company. That formula works. So it has been shown that 0 to 10 PE will give you a alpha return of 5% in 3 years. Alpha return means whatever with high ROE and high growth you are getting, 27% annual growth, above that 5% you can get if you are buying at such low PE, because you are paying lesser price for the same value. So that time you can get this alpha. Okay. If you are buying with 10 to 20 PE, you can get a alpha of 1%. Here also you are getting more. But if you are started to buy more than 20, your alpha will be negative, means now you are buying it at costly. If you are buying more than 50, then your alpha will be minus 8%. Almost you are losing, you are gaining almost like a Sensex. It's better to buy an ETF, exchange traded fund, or Nifty or Sensex, rather than the stock, because now you are giving very high price. P ratio is very high, above 50. So you should always wait for corrections. In market correction, such high return companies also will be available at low PE. That time you should buy. Now next is P relative to market. What is P relative to market? Market has its own P ratio. You can go and search in Google that what is the P ratio of Nifty. You will get around some 21 or 20, that value you will get. So that is the market P. So suppose some stock you are getting now which is below that market P, 20 21 P, that is cheap. Simple terms, that is cheap. P below market works, and above 2x market doesn't. Suppose you are paying 44 P for some stock, whereas Nifty P is 22, then it is going to be blunder. Maybe you will not get much returns. So that you should avoid. You should be having patience to wait for market correction for the same company. It will be available. So P ratio you should see below market P. If it is lesser than 1, you will get 4% alpha. That has been seen in past. Now next is PEG ratio. What is PEG ratio? It's simply P divided by future earning CAGR. So P ratio, you have TTMP. This you will get in many sites are available. 12 months trailing P. So that you have to divide with future earning CAGR. Suppose 12-month trailing P is 20x and expected 3-year growth rate is 25%. Your PEG ratio is 0.8. So PEG ratio, once you get, the next slide will show you that PEG ratio If it peg ratio of less than 1 is working all in all cases, 1 year, 2 year, 3 year, 4 year, 5 year, any period if you take, the alpha means the higher return you will get always in any case. Sensex returns was negative, whereas peg less than 1 was negative only, but it was lesser in 2000 to 2005 period. In 2008 to 2013 period also you will see this was working, and this period also this was working. So this always works. So you should always look for peg ratio less than 1. Peg ratio less than 1 has given 19% alpha. You see 19% above that 21%, 27% of high ROE, high growth. Above that 19% you can get if you can buy such companies when the peg ratio is less than 1. Recently HDFC Bank last I think some 6 7 months before, it was the price was around 1380. One fine morning I saw that HDFC Bank was available at around 1380, 1380. That time the peg ratio was around 0.81. So it was available at very lesser peg, and that time I bought that. So now it is around 1900. It has always already given some 50% return. So that peg ratio always works. So you should always be looking for peg ratio for such high ROE, high growth companies. Okay. So payback ratio. Next is payback ratio. What is payback ratio? Is the current market cap divided by next 5 years of PAT. So if it is less than 1, this also is giving very high alpha of 17%. So you should always look for this high ROE, high growth companies, whether this payback ratio you are getting in less than 1. Next is price to book value. Price to book value less than 1 is rarely you will get for such good companies. But if you are getting in some COVID conditions or any war condition or any uncertainty condition, you will get. In COVID time, December 2020, I saw SBI. I saw SBI Bank. It's not a high growth, high ROE company, but even though it's a good company, I know it's a good bank. SBI was available at around 256 rupees. 256 rupees was the per share price, and I think book value was around 320 something. So it was below the book value. So that was the time to buy. So like this you will see the some good companies at from lesser than book value, less like price to book value less than 1. Some cases when the market situation is not good, that is the time to buy them. That will give you a alpha of 6%. That has been given alpha of 6%. Like this price to sales, if it is less than 1x, this will also give you alpha. So summary, we can say that these are the metrics. If you are getting a high ROE, high growth company, you should buy when these are the values. Like if something you will get peg ratio less than 1 and payback ratio works very beautifully. These two if you are getting, you have a multi-bagger for sure. Other things in market situations will create for some correction. When market correction happens, you will get these things also. You have to be watchful. So this is the pricing summary. You should always look for these opportunities. Okay, so now we can conclude these slides that the two key drivers for the values are return on equity and earning growth. We have seen that return on equity and earning growth determines value. Then we saw that value companies create value only when they earn ROE higher than cost of equity. Cost of equity was 13% we saw, and if more than 13% ROE was there, then only any addition of earning growth was adding the value. So you have to always look for company which are having higher ROE of 20, 25, 30. Low ROE companies should focus on increasing ROE, and high ROE companies should focus on increasing growth. Let them focus. You should focus while buying that in quarterly results or annual results, the low ROE companies are whether increasing ROE or not, and high ROE companies whether they are increasing growth or not. This is your work, your homework you should do. Now peg ratio less than 1x is near infallible formula, like it never fails. So if you are getting some such good company, high ROE, high growth company with lesser peg ratio than 1, like I told HDFC Bank, now also it is available less than 1x. So that is very healthy performance. So that formula never fails, and we should grab this opportunity with both hands with whatever capital we have. So current market valuation demand robust earning growth, which remains elusive, hence accept market to remain soft. So we need higher earning growth, high ROE, and PEG ratio should be less than 1, payback ratio should be less than 1, and in certain market situation you will get price to book, price to sales also less than 1. So such opportunities we should always look for to get a good value at lower price. So this was the whole value investing exercise, and hope you learn a lot from this. You can see again, if you have any doubt you can comment, you can share this video to your friends, relatives who can learn this value investing, so that they should not buy any stock at very high price, because that is the case most of the time where we lose a lot of money in stock market. If we try to be patient and wait for such opportunities in good companies, like now FMCG companies are available at very lesser prices, so maybe it is reasonable with value. You can go and see this matrix for Asian Paint and such companies where high ROE, high growths are there, but because of current market situation they are available at very lesser price. Maybe their peg ratio and their other parameters you can go and watch that when it will be available at decent value, that is the time to purchase them. Again they will be flying like anything. So you should always look for these opportunities are always present in market. Okay, so this making this presentation objective was to tell you in very simple language how you can judge for a retail player the value, and how you can decide that whether this stock price is reasonable or not. Already Ramdev sir has himself has presented this very well, and I wanted to show to my subscribers also this thing, so I copied them and presented. So hope you like it. If you like it, you can subscribe the channel, and you can tell me what else topic you want the video. Okay.